Hi class. So for this session, we will be still talking about adjusting accounts for financial statements, and we will be focusing on unearned revenues. So we would like to prepare and explain adjusting entries for unearned revenues. To repeat, we have several types of adjustments. You have here your prepaid expenses, depreciation, unearned revenue, accrued expense, and accrued revenue. Now let's focus on what is unearned revenues. So accrued revenues refer to cash received in advance of providing products and services. So it says here that we received cash, okay, in advance of providing products and services. So in layman's term, we already received the cash from our customer, but we did not provide any service to them yet, or we did not deliver any goods to our customers yet. Since we did not perform any obligation yet, or we did not perform any service to our client yet, or to our customer, that will constitute as a liability on our part. Okay? So when we accept the cash, okay, when we receive cash from our customer, we have an obligation to provide products and services to be accepted. Okay? However, on this case, we just received the cash, but we haven't performed any service yet to our customer. As products and services are provided, the amount of unearned revenues become earned revenues. Okay? So initially, this unearned revenues would be liability, right? That is, if you do not perform anything yet to satisfy your customer. But once you performed already your service, okay, or you've already provided the goods or the items to your clients, then this liability will be translated to an actual revenues or sales. Okay? The default of unearned revenues, this would be your liability. And we receive already cash for this one in advance. So the common types of your unearned revenues, okay, would be your interest expenses, okay, right? So you have here unearned revenues saying that adjusting entries for unearned revenue is involves increasing, okay? You will increase your revenues as a result of the service that you provided to your customer, and you will be decreasing your liability that arose from your unearned revenues. So initially in your liability, right, the normal balance of your liability would be on the credit side. However, as you perform services or as you deliver goods or items to your customers, you will need to decrease the value of your liability and transfer it as part of your revenue or sales. So we have sample transaction here. Okay, so it says here that on March 29, 20x3, we entered into a contract to provide food catering on April 7, 20x3. We received $3,000 cash in advance of the event. So first, let's analyze the transaction. Is this transaction a financial or non-financial transactions? So reading through it, it seems like first we received cash, okay, in advance of the event. So when we receive cash, what is the effect of it on our asset account? Of course, our asset account will increase because we received $3 amount of cash. Okay. On the other hand, we have an obligation. Okay, we entered into a contract. We have an obligation that we will provide food to our customer on April 7. And this obligation is yet to happen. So this is still what? This is still a promise or a commitment. Okay? So in this case, you have cash in the form of an asset and an earned revenue or a promise in the form of liability. So let's first journalize the transaction on March 29. Okay? Let's determine first like what are the original transactions that happened. So first thing, our cash account increased in the amount of $3,000. So for any increases, you will put it on the debit side. So again, put the date of the transaction here, March 29, and then debit cash for $3,000. And then the contract to provide food catering or your obligation to provide service on April 7, that again is a liability, specifically unearned revenue. And since our liability increase, it will be recorded on the credit side. So you have here credit unearned revenue amounting to $3,000. Also put an explanation or a note, right? So that the reader can understand what happened on this certain transaction. In this case, we collected payment for future services to be provided. And of course, for all journal entries that we prepare, we should update it in our ledger. So in this case, we have here cash, our cash increased. That's why in the T account for your cash, you have here debit amount of $3,000. Okay? And then your unearned revenue, also prepare a detailed record for this one. And since this is a liability, that amount will be displayed on the credit side of the T account. So again, your initial entry here would be a debit to cash for $3,000 and then earned revenue $3,000 because on March 29, we received already a deposit or an advance payment to us by our customer in the form of cash amounting to $3,000. But yet, we did not perform any obligation yet. Okay? As for the month of March, as of March 29. But instead, we will be performing these services on April 7, 20x3. Okay? So, next slide. Let's try to dissect what happened on the second bullet point. This one. Right? So it said here that we will be providing food catering services on April 7, 20x3. However, there was an advance food that was delivered on March 31, 20x3. We provided food services to the client amounting to $250. Okay? So initially, class, your liability was worth $3,000. Correct? Because this was your agreed contract. You will deliver food in the future amounting to $3,000. But on the second bullet point, it seems that on March 20 X3, you already delivered partial of what you are obliged to do in the form of or in the amount of $250 worth of food catering services. So what do we need to do in case we've already partially, all right, or fully provided services to our client? So we need now to adjust or to translate the liability into actual revenue or into actual sales. Okay? So since you have an initial liability of $3,000, this one, a liability, you need now to decrease this liability by $250, okay, to generate actual sales amounting to $250. So what is the correct approach when you decrease liability? Again, for any decreases in liability, that will be shown on the debit balance. That's why in your adjusting entry as of March 31, you debited an earned revenue, which is a liability amounting to $250. And since this signifies that you already performed something to your client for the amount of $250, this will now be part of your revenue or your sales. So your credit here would be a revenue account amounting to $250. Okay? And then, of course, for any accounts that are affected as a result of your adjusting entry, update your detailed record or your ledger. In this case, let's focus on unearned revenue first. Initially, you had you have an outstanding liability worth $3,000 as of March 26. Again, on March 31, you performed something, okay, to your client. You already fulfilled a partial amount of it. So you need to decrease the value of your outstanding liability or your obligation. In that case, that was $250. So get the total balance or the updated balance of your unearned revenue simply by deducting your credit account versus your credit account. So $3,000 minus $250, you would have an unearned revenue as of March 31 amounting to $2,750. And then this extinguished liability as a result of your performance of your service, this will now be categorized as part of your revenue or sales. Okay, so as of March 31, your revenues is $250. Again, you will recognize this now as part of your sales or your revenue or your income because you already performed actual service to your client. But it may not be full amount of $3,000, but still you performed something partially amounting to $250, which is already an income on the part of ABCXYZ company. If you have any questions, please feel free to pin it in the comment or ask it during one of our classes. Thank you.